In the last 100 years, the market has sent this exact signal only 3 times. And in all 3 instances, those who clung to their stocks watched their wealth evaporate as gold surged to dominance. Today, we're standing at the 4th signal. The question is, are you holding paper or are you holding real value? Look at the person next to you. If they are like 52% of American households right now, their entire financial future is tethered to the stock market. It's the highest level ever recorded, higher than the dot-com bubble, higher than the 2007 pre-crash peak, higher than any point in the last 65 years. Most people call this a bull market. History calls it a crowded exit. Think about it. When everyone owns the same thing at the same time, who is left to buy? We've been told for decades that stocks are the ultimate wealth builder. And on paper, that looks true. But if you measure your portfolio in ounces of gold instead of depreciating dollars, the stellar returns of the last 20 years start to look like a slow-motion collapse. In this video, we aren't just looking at charts, we're decoding a 100-year battle for purchasing power. I'm going to show you the TSI signal, the 4th one in a century, and why the smartest money in the world is quietly moving from the exchanges of the West to the vaults of the East. The herd is celebrating at the edge of a cliff. Let's look at the data they're ignoring. The crowd is currently euphoric, mesmerized by the flashing green numbers on their screens. But have you ever stopped to ask yourself, why does your bank account have more zeros, yet your purchasing power feels smaller than ever? Look at this chart, not the one your broker shows you, but the real one. Right now, 52% of American household wealth is tied up in stocks. Let that sink in. 52%. That is the highest level in history. To give you some perspective, this is significantly higher than the peak of the dot-com bubble in 2000 and the pre-crash euphoria of 1929. We're in uncharted territory. People aren't just investing, they are all in. They believe the trajectory is permanent. But here is the twist that the mainstream media won't tell you. The stock market isn't actually growing, it's just being inflated by a currency that is losing its soul. To see the truth, we have to look at the S&P 500 divided by the M2 money supply. This is what we call adjusting for reality. When you look at the S&P 500 in isolation, it looks like a rocket ship heading for Mars. But when you divide that price by the sheer amount of dollars the Federal Reserve has printed and pumped into the system, the picture changes completely. In real terms, meaning in terms of actual purchasing power, the S&P 500 hasn't made a new high since 2021. What you're seeing today isn't a bull market, it is a massive global devaluation parade. Imagine you're running on a treadmill. The display says you're doing 10 miles per hour, but the treadmill itself is sliding backward at 9 miles per hour. On the screen, you're a star athlete. In the room, you've barely moved an inch. That is exactly what is happening to your stock portfolio. Your 10% gain this year isn't profit if the cost of the life you want to live has gone up by 15%. You aren't getting richer, you're just holding more pieces of paper that buy less and less. History is very clear about what happens when household stock ownership hits these extreme overallocated levels. In 1929, the euphoria led to a multi-decade winter. In 2000, the new economy hype led to a 50% haircut for the S&P 500 and an 80% slaughter for the Nasdaq. The logic is simple but brutal. When everyone has already bought, who is left to drive the price higher? We are currently sitting on a mountain of paper wealth. It looks majestic, it looks solid, but it's built on a foundation of diluted currency. And while the retail crowd is busy celebrating these fake highs, the smartest money in the room, the players who have survived for centuries, are looking for the exit. They aren't looking for more paper. They are looking for a compass that actually works in a storm. And that brings us to a metric that has been the ultimate truth teller for over a century. A metric that tells us exactly when the king is wearing no clothes and when it's time to switch sides. I'm talking about the Dow-to-Gold ratio. And if you think the S&P chart was shocking, wait until you see what this forgotten compass is telling us about where we are headed next. If the S&P 500 chart we just looked at was a wake-up call, then this next indicator is the entire alarm system. It's a metric that Wall Street rarely mentions, but it's the only one that truly measures the real value of the American economy. It's called the Dow-to-Gold ratio. The concept is dead simple. How many ounces of gold does it take to buy 1 unit of the Dow Jones Industrial Average? No dollars, no inflation, no central bank magic. Just pure, hard asset-to-asset comparison. Think of it as a financial tug-of-war. On one side, you have human ingenuity, corporate profits, and stock market growth. On the other side, you have the ultimate anchor of stability, gold. History shows us that this tug-of-war moves in massive, multi-decade waves. And every time the rope pulls too far toward stocks, it eventually snaps back with a vengeance. Let's look at the rhythm of the century. First, 1929. At the height of the Roaring '20s, the Dow-to-Gold ratio hit a massive peak of roughly 18. Stocks were king. Everyone was a genius. Then came the Great Depression. Over the next few years, the ratio didn't just drop, it nosedived until it hit 2. 2 ounces of gold could buy the entire Dow. Stocks were dead. Gold was the only survivor. Then came the 1970s. In 1966, the ratio peaked again, this time around 28. Once more, the consensus was that stocks would go up forever. But then came the era of great inflation. By 1980, the ratio crashed all the way back down to 1. Imagine that. 1 ounce of gold was equal in value to the entire Dow index. If you held stocks, you were wiped out in real terms. If you held gold, you were the new elite. Now, look at 2000. The dot-com mania pushed the ratio to its highest point in human history, 44. It took 44 ounces of gold to buy 1 unit of the Dow. It was a statistical impossibility. Naturally, the tech bubble burst, followed by the 2008 financial crisis. The ratio tumbled back down to about 6 by 2011. Which brings us to right now, in 2026. The ratio has climbed back up to the 2022 range. Look at the pattern. Every single time we enter this overextended zone of 20 or higher, the market begins to suffocate. The system becomes top-heavy. The paper wealth is simply too high relative to the physical anchor. When the ratio is low, you buy stocks. When the ratio is high, you buy gold. It is the most reliable buy low, sell high signal in history. And right now, the compass is pointing directly at the exit. If stocks are the king during the period of easy money and printing presses, then gold is the savior when that system reaches its breaking point. Mark Twain once said that history doesn't repeat itself, but it often rhymes. And right now, the music is shifting. The rhythm of the last decade is fading out, and the heavy beat of a new gold era is starting to play. But why is this happening now? Why is the 4th signal in a century finally flashing red? The answer isn't just about American investors anymore. It's about a massive, silent migration of wealth across the entire globe. A migration that is rendering our old Western playbooks obsolete. To understand the endgame, we have to look at where the physical gold is actually going, and why the world's most powerful central banks are suddenly acting like they know something we don't. While retail investors are distracted by the shiny paper highs of the S&P 500, a silent but massive tectonic shift is happening beneath the surface of the global financial map. The smartest, most powerful players in the world, the central banks, are no longer just talking, they are moving. According to the World Gold Council, we are witnessing a buying spree of physical gold that we haven't seen in generations. But look closely at who is buying. It's not the West, it's the East. The BRICS Plus nations are accumulating gold at a rate that suggests they are preparing for a world where the dollar is no longer the only game in town. This brings us to a fundamental law of economics that explains exactly why this is happening. Gresham's law. In simple terms, Gresham's law states that bad money drives out good. When a government overprints its currency, debasing its value and turning it into bad money, people and nations start to hoard the good money. They spend the depreciating paper as fast as they can, and they lock away the physical, indestructible assets. The East is playing the ultimate game of Gresham's law. They are offloading their U.S. treasuries, their paper promises, and replacing them with heavy, physical bars of gold. They are trading bad money for good money before the rest of the world realizes the music has stopped. This isn't just a conspiracy theory, this is a mathematical inevitability. And it leads us back to that signal of the century I mentioned earlier. Look at this indicator from North Star Bad Charts. It's called the TSI, the True Strength Index. It's a 5-month smoothed momentum oscillator that filters out the daily noise and looks only at the deep, unstoppable trends of history. In the last 100 years, we have seen this specific bull era signal for precious metals and commodities only 3 times before. Every single time this crossover happened, it marked the end of a stock market era and the beginning of a massive multi-100% explosion in the value of gold, oil, and hard assets. Congratulations, you are currently living through the 4th signal in a century. This is the tipping point where the Dow-to-Gold ratio we discussed earlier begins its long, painful slide back to reality. We aren't talking about a 5% or 10% move. We are talking about a fundamental repricing of the world. The narrative you hear on the news, that the economy is great, that inflation is under control, that stocks are the only way to build wealth, is what we call a fairy tale. It is designed to keep you in the bad money, while the good money is being quietly vacuumed up by the global elite. So what does this mean for you? Does it mean the stock market goes to zero tomorrow? No, but it means that in the battle of assets, the era of easy equity gains is being replaced by the era of hard asset survival. We are moving into a period where it's not about how many dollars you have, but what those dollars can actually buy. As we reach the conclusion of this 100-year battle, there is one final question you need to ask yourself. And the answer will determine whether you end up as a casualty of the paper wealth trap or a winner in the new gold era. Ready to wrap up this viral masterpiece? We've covered a century of data, from the fake highs of a debt-soaked stock market to the silent accumulation of gold by the world's most powerful central banks. But at the end of the day, this isn't just about charts or ratios, it's about a choice. Gold is not just a shiny metal or a piece of jewelry. It is the ultimate insurance policy against the inevitable decay of paper purchasing power. While stocks might win the battle of headlines in the short term, the 100-year war belongs to real assets. The cycle is turning, and it's turning fast. History has officially sent its signal, the 4th one in 100 years. The message is clear. The era of blind faith in paper wealth is ending. So where do you stand? Will you choose to stay with the crowd, pushing and shoving at the exit when the reality of devaluation finally hits? Or will you quietly position yourself with the asset that has never once betrayed its owner in over 5,000 years of human history? This is the moment to look at your portfolio not in terms of how many dollars it's worth, but how much life it can actually buy when the dust settles. How much of your portfolio are you planning to allocate to gold in 2026? Are you hedging for a storm, or do you still believe the paper rally has legs? Leave your thoughts in the comments below. I read every single one, and I want to know how you're preparing for this shift. If you found value in this deep dive, hit that like button and subscribe to stay ahead of the curve. The rhythm of history is playing. Make sure you're dancing to the right tune. Thanks for watching.